Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies stock, Tesla stock, as well as NIO stock. We're going to be analyzing 3 different articles, to where the first one is titled, SoFi stock, is it a good investment for you right now? So clearly we're going to be going over their latest price targets, their future growth trajectory, as well as their upcoming news catalysts. After that, we'll move on and discuss why Tesla recently lost one of their top executives, which would be their chief financial officer, who was supposed to actually replace eventually Elon Musk himself, according to the Wall Street Journal. So we're going to be doing a deep dive into this story regarding why he left and what this means for Tesla as a whole. And then lastly, we're going to talk about another electric vehicle company named NIO, and we're going to discuss whether you should buy, sell, or hold this company, because right now NIO is on a huge growth trajectory and they are on the way to becoming profitable. So for more videos just like this one, don't forget to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, don't forget to become a member of this channel to support me personally. Thank you for all of my existing members, and if you want to become a member to keep me here on YouTube, you can do that for as little as 99 cents, because that's what allows me to make videos like this one. But with that being said, I say let's dive right into today's stories. SoFi Technologies is a fintech company, or a financial technology company that operates as a digital bank, and right now SoFi Technologies has had investors buzzing with excitement ever since the stock price soared by around 20% after their very impressive revenue and earnings which they brought in that beat analysts' expectations regarding their earnings report. Now, concerning their overall share price, their stock is actually up around a whopping 148% year to date, which is extremely impressive, something that we've actually called and predicted probably a year and a half ago. Now, you might still be wondering whether or not SoFi Technologies is a good investment right now, or if it's overvalued, and that's exactly what we're going to be discussing in this video. So we're going to dive into whether or not this stock is worth buying. Right now, SoFi Technologies trades for $9.33 per share, while negative analysts believe this company is worth around $3, while more bullish analysts believe there is still further upside in this company over the next 12 months because it could reach potentially $16. In previous videos, we have predicted pullbacks in this overall company, and on screen you can see their year-to-date stock chart, to where 2 pullbacks have happened. One here and then one recently right here. So essentially, after pullbacks, these are opportunities to buy the company, because once the stock price runs up in price past a certain point or too aggressively, we automatically know a pullback is coming, and it's always best to buy, in my opinion, on pullbacks or on these lows, because it allows you to have a very low average cost basis for this overall company, meaning that the future growth of this company is going to be very valuable and worthwhile for you, because it's going to allow you to compound your overall gains and profits. Now, although the financial industry right now is in somewhat of a risky situation, considering rising inflation, high interest rates, the housing market being crazy, and overall many financial institutions buckling under the pressure, many investors are still being attracted to SoFi Technologies because of their remarkable revenue growth and the fact that they are intended to become profitable by the end of the year. SoFi right now has maintained consistent double-digit quarterly revenue growth rates, which is very impressive. For instance, during the second quarter, they increased their overall growth by around 37%, or at least that's what they brought in regarding their CAGR, which is very impressive regarding a quarterly year-over-year growth rate. Additionally, the company recorded very impressive adjusted EBITDA, which is just an acronym which stands for earnings before interest, taxes, depreciation, and amortization, and their adjusted EBITDA margin was around 16% in quarter 2, which destroys their past margins of 5.7% and 4.7% respectively in quarter 2 of 2022 and in 2021. So their EBITDA is a good way for the company to display their overall potential bottom line profitability. And considering that the company is intended to become profitable by the end of the year, this is going to be phenomenal for investors. So some investors are trying to buy up the stock right now before the company becomes profitable during the 4th quarter. However, I've been in this company for the long term, and if you know me, I don't allocate more than a 5% initial portfolio allocation to any singular risky growth company, including this company. However, what I do like about this company is their business model. They have a flywheel business model, or also known as a financial services productivity loop, or FSPL strategy. This is essentially a strategy where they acquire customers and they cross-sell or upsell those customers in their overall business model. So if you only came in to refinance your student loans, they're also going to cross-sell you you on credit cards or even upsell you on other products. This is due to four main things that SoFi, I think, does better than almost any other company in the finance space. They have data-driven decision making, so their management can make well-informed decisions. They offer personalization for their overall customers. Their technology is amazing because their technology uses artificial intelligence to automate and streamline tasks to reduce their financial platform's operating costs, and they also offer additional products and services that not many other banks offer. So when we combine these four components of SoFi Technologies, you have a best-in-class customer experience, and this is reflected very positively in their overall member growth, which is growing at a very impressive rate, around 44% year over year. And they are not only growing their members, but also their products, to where their products have grown by around 43% year over year, meaning that their business model is working very well, so they are meeting their FSPL goals regarding their flywheel business model. This business model also allows them to increase their operating efficiency. So essentially, when a company becomes more efficient, it can produce more while spending the same amount or less on the exact same products, thus decreasing its overall operating expenses as a percentage of their revenue. So as time goes on and they take advantage of this operating efficiency, this is going to reflect very positively on their overall financials. However, I do want to make investors aware of the risks of SoFi Technologies. Depending on how you value SoFi Technologies, this could be a problem, because right now their price to book value and their overall PS ratio is higher than a lot of their competition, such as when we compare their price to book value, which is 1.819, to peers like Western Alliance Bancorp, Wells Fargo, PNC Financial Services Group, CVB Financial Group, and Truist Financial Corp. And you can see how their price to book value is all over here, including their PS ratio, or their price to sales ratio, which essentially compares the company's market cap to the amount of revenue that they bring in. And ideally, we would want these to be as low as possible, but SoFi Technologies has higher PS ratios and price to book value ratios than these other companies. However, I think that the growth rate of SoFi Technologies successfully offsets these overall premiums, because SoFi is also growing a lot faster than these other institutions. Therefore, their higher premium is justified. However, for those of you who have more of a conservative investment analysis, then this may not be the stock for you. But if you are more of an aggressive long-term investor, then consider holding your shares over the long term, or at least until this company achieves profitability in Q4 of 2023. But overall, I would say this company is well on their way to being a phenomenal long-term investment. Now let's talk about Tesla's TSLA shares and why they lost their top executive. So Tesla recently announced that Zachary Kirkhorn, who is the company's chief financial officer, also known as CFO, has stepped down. And this recent announcement surprised a plethora of investors and professionals, considering that he has given the company his 13-year-long tenure. However, nonetheless, he officially resigned on Friday, but he will remain with Tesla until the end of 2023. However, the specifics surrounding his resignation has not been specified as of right now. Tesla as a company came out with a statement saying that Mr. Kirkhorn stepped down as of August 4th, after a 13-year tenure with the company, the last 4 years of which he has served as Master of Coin and Chief Financial Officer. During his tenure, Tesla has seen tremendous expansion and growth. Tesla thanks Mr. Kirkhorn for his significant contributions. Meanwhile, this CFO who is leaving the company shared his appreciation for Tesla via LinkedIn and replied to Tesla's overall comment. He says that this morning, Tesla announced that I've stepped down from my role as Chief Financial Officer, succeeded by our Chief Accounting Officer. Being a part of this company is a special experience, and I'm extremely proud of the work we've done together since I joined over 13 years ago. As I shift my responsibilities to support this transition, I want to thank the talented, passionate, and hardworking employees at Tesla who have accomplished things many thought not possible. I also want to thank Elon for his leadership and optimism, which has inspired so many people. So we can garner two things from this. One is that the company's accounting chief since 2019 will be the new chief financial officer. And the second thing that we can gather is that this was very abrupt and last minute, but we didn't really get any reason why he left as of right now. I'm sure more details are going to come out later about this. However, this is very odd considering that this was the CFO that led Tesla to profitability, and he allowed the company to repay around $10 billion in debt within just 3 years. So he is one of the best CFOs in my personal opinion. So all of this has had analysts absolutely on edge about how this other person is going to take their place and whether or not this is going to compromise Tesla's future. Analysts for a long time thought that Kirkhorn would eventually succeed Elon Musk as Tesla's CEO, as the entrepreneur that he is, to open and operate other companies while still sitting on the board. And according to the Wall Street Journal, this did take analysts by surprise because analysts were a shoo-in that Kirkhorn was going to eventually take Elon Musk's place in Tesla in a similar way of how Tim Cook took Steve Jobs' position at Apple. So with a lot on Tesla's plate right now, such as the company expanding into India and their new gigafactory over in Mexico, along with the Cybertruck's rollout this year, Tesla has a lot on their plate. So it's going to be interesting to see what the future of this company holds, but overall, that is a top story regarding Tesla. Lastly, let's talk about another electric vehicle company, which is NIO, which is located over in China. And what I like about this company is that finally, the company is gaining traction. The Chinese EV maker NIO, ticker symbol NIO, has been struggling due to supply chain issues, lockdowns, and a lot of geopolitics. And investors have been pushing the stock price down due to their vehicle production lagging and profitability looking further and further away. However, recently the stock has nearly doubled since May, making it a great time for investors to reevaluate this company to determine whether or not this company is a buy, sell, or hold. Clearly on screen you can see that their stock chart has gained a lot of momentum to where current shares are trading for around $14.08, while bearish analysts believe it could fall down to around $6, and other analysts believe it could surge up to $21. As of right now, yes, NIO is very expensive, but for the remainder of the year, especially into 2024, this company is supposed to rapidly increase their overall production and sales numbers. The remainder of 2023 is going to be where NIO is going to rapidly expand. The company completed construction of its new production facility in China just over a year ago, and they have the capacity now to produce more than 1 million electric vehicles annually. On top of that, NIO entered the European market back in 2021, starting with Norway, and by the end of last year, the company had plans to enter Germany, the Netherlands, Sweden, and Denmark. So clearly they are pressing on into other companies right now. But despite all of this, their production growth stalled out in 2022 and during the first half of 2023, until I predicted that during the second half of 2023, we could see a production and delivery boom, which would reflect very positively on their overall revenues. And we saw exactly that. NIO announced that it delivered a record number of electric vehicles in July, to where NIO delivered more than 20,000 electric vehicles. And if you see the chart over here of their overall deliveries, this giant spike right here is exactly what I predicted during the second half of 2023. I also want to note that of these 20,462 vehicles that were shipped, these were mainly comprised of the company's newest offerings, meaning that there is a surge of demand for NIO products and vehicles. On top of that, we have their power segment, which offers traditional charging through charging stations and networks, as well as their mobile charging and battery swapping stations, which is the thing I really like about this company. I think it diversifies them among other electric vehicle makers, because if you can swap out a battery in around 5 minutes rather than having the battery charge at a charging station for 10 to 20 minutes, clearly battery swapping stations are far more efficient. As of March 2023, NIO had more than 1,300 power swapping stations, including nearly a dozen over in Europe. And they also brought in very impressive revenue of around $1.5 billion during the first quarter, while NIO reported a net loss of around $700 million. Investors need to realize that there still is a long road to profitability, even though their revenues are absolutely amazing, and currently profitability is projected out until 2026. So there could be major long-term success here, and NIO investments could pay off over the long term, but this really comes down to how long are you willing to wait for this company. For me, if you're like a regular investor, feel free to wait until 2025 or 2026 to where profitability is around a year away, because anything could happen between now and that time. But if you are an aggressive long-term investor, feel free to pick up some shares at a very moderate price, but do not overexpose yourself to any singular risky growth company more than a 5% initial portfolio allocation, and that would be proper risk management. But I'd love to hear your thoughts down below about NEO stock, SoFi stock, and Tesla stock. Don't forget to go and annihilate that like button, comment your thoughts down below, subscribe if you are new, don't forget to become a member of this channel to support me personally, and I will see you in the next YT video.